Greetings to the most amazing army of XRP. I will not squander any more time. Let's get straight to the video for today. I'm about to tell you something that will blow your mind. You should listen to this if you now own XRP or want to purchase any quantity of XRP. What if I told you that organizations like BlackRock, Fidelity, and Grayscale dumped over 18 billion in Bitcoin in the previous 12 months alone? This would have destroyed more retail investors than any inflation concern could have. Additionally, XRP and the whole cryptocurrency market are currently the targets of attacks. You'll see how potentially transformative October and the upcoming cryptocurrency cycle can be. I therefore ask that you, the incredible viewers, grab a cup of coffee, settle in, and let's get started. Click like to help this video reach more incredible people like you, and click subscribe to ensure you don't miss any significant market updates. Now, fantastic XRP viewers, let's dive straight into the important details. For those of you who are unfamiliar with the cryptocurrency market, the current decline is not natural, even though I'm sure many of you are seeing a lot of headlines. The purpose of its meticulous timing and execution is to extract money from individual investors. The first error made by novice investors is to assume they know more than they actually do, and then to panic when the moves become more abrupt than they should. Institutions are precisely dependent on that terror. This is the cycle. A large red candle strikes. Retail panics for explanations, but rumors and anxiety aren't the true causes of price collapses. Massive, well-coordinated withdrawals from ETFs, owned by industry titans like Vanguard, Fidelity, and BlackRock. The regulations permitted BlackRock up to 21 days to sell assets following withdrawals when they first introduced their Bitcoin ETF. This implies that they are not need to sell right away if billions of dollars leave the fund today. Weeks later, they can dispose of it whenever they choose. Now picture this. 30 terabytes, 5 billion out. After 2 weeks of waiting, everything happens at once. The price of Bitcoin, Ethereum, and XRP immediately plummets once they dump billions into the market. However, they might stealthily stock up on shorts before selling, ensuring gains while the market is weak. Amazing XRP viewers, we have a limited amount of time to cover a lot of fascinating topics. You can see in this video how companies like Fidelity and BlackRock are utilizing ETF flaws to cause cryptocurrency collapses. How these actions covertly move billions from individual traders to Wall Street, and why XRP is one of the simplest targets. By the conclusion, you'll understand exactly how the game is played and why it matters for all XRP holders, although most investors don't realize the trap until it's too late. Ladies and gentlemen, let's dive right in without further ado. This is not a theory. It has already taken place. A 10% collapse was brought on by BlackRock's 1.2 billion Bitcoin ETF withdrawal. A 12% decline was caused by Fidelity's 500 million ETH outflow. A harsh 20% correction resulted from Grayscale's 18 billion Bitcoin outflow. Additionally, it was simpler to manipulate smaller cryptos. Only a small portion of such volume is required for altcoins like XRP, Solana, and others to crash. Institutions take advantage of this knowledge. The majority of investors are unaware of the extent of these companies' flexibility. The same limitations that apply to retail dealers do not apply to them. They can use batch liquidations, stake their sales, or even work indirectly with other ETFs by sharing custodians. They have the authority to determine not just when the market declines, but also when it rises. Consider that. And they make as much money from that recovery as they did from the crash. After creating a panic, buy low. When the bounce starts, sell high. If that painting is being painted for you, please let me know. It is the pinnacle of market engineering. This is the portion that most people find most astounding. ETFs generate revenue from sources other than management fees. Forced liquidations are where the big money and the real payoff come from. They cause retail panics, the dump, institutions take the profits from short sales and low-cost repurchases while leveraged longs are wiped out. This is why it should make everyone sit up in just an hour. ETH, Bitcoin, and XRP longs totaling 500 million were all gone. Liquidated, boom. That money didn't simply disappear, it went directly into the hands of the institution. I need you all to pay attention because This is when things start to become really interesting. Focus on XRP in particular. In this particular synthetic flush, XRP has already been driven below the $3 range. But people, take a look at the pattern. In this cycle, there has been a significant rebound effect after each significant dip. Institutions left on September 22nd of this year. After that, prices fell and then rose sharply in a matter of days. The same playbook keeps coming up. An opportunity for disciplined purchasers, followed by a trap for panic sellers. Compared to Bitcoin and Ethereum, XRP's liquidity pool is significantly smaller, making it more vulnerable. Moving XRP doesn't require billions. Even while the fundamentals are still the same, a concerted sell-off of hundreds of millions is sufficient to give the appearance of collapse. And that's the important thing here. The price and the fundamentals are two different realities. Knowing this is extremely crucial. Institutions use the difference between the two as a weapon. The price is initially lowered to shake out retail confidence, even though fundamentals may indicate adoption, increasing utility, or the approval of a new ETF. Institutions take a back seat and ride the recovery the moment retail quits up. Some individuals who caused the crash also benefit from the same recovery in this way. This is what, for those who comprehend it, makes this time even more hazardous and lucrative. The United States recently increased GDP growth to 3.8%. More rate cuts have already been affirmed by the Fed. We'll see liquidity soon. The money supply is going to grow. In order to position themselves ahead of that influx of cash, institutions are well versed in using volatility. In addition, global AI integration is increasing GDP, cutting expenses, and increasing productivity. This is fuel, not just any old backdrop. Institutions will use volatility as a weapon right now in order to amass assets ahead of the next liquidity surge. However, this is the secret layer that hardly anyone discusses. ETFs are more than just devices for passive investing. They serve as influence-gathering Trojan horses. Consider it. BlackRock and Fidelity are indicating where the cash is beginning to flow each time they publish inflows and outflows. Retail also fails mindlessly. That information alone turns into a weapon. Institutions are able to observe the growth of liquidity. Next, deliberately create turbulence in its vicinity. For instance, they can timing ETF withdrawals to set off a series of liquidations if they are aware that billions of dollars are about to expire in future contracts. It's engineered market control, but not manipulation in the legal sense. The entire purpose of this film is to show how most investors are unaware of this. Many thanks. I will see all of you tomorrow. Be careful.